Manojit, we can start now.
Hello, everyone. Good evening, and welcome to a new edition of the Indian Express Explained Live, earlier known as E-Explained, our series of online explanatory conversations with domain experts and authorities on specific subjects. Tonight's event is in association with Vision IAS. I am Monojit Majumdar, editor for explanatory journalism at the Indian Express. We think of explained the content in our paper, on our website, as well as in events such as this one, as being rooted in the news, but going beyond just the news. So explained is context, explained is background, explained is connecting the dots, explained is analysis. This evening, we are talking about the economy and specifically the budget. What was the task before the Finance Minister earlier this month, and how did she choose to accomplish it? What lies ahead for the economy in this year and in the foreseeable future? Explaining these topics and a lot of other things is the Chief India Economist of JP Morgan and part-time member of the PMEAC, Sajjid Chinoy. Sajjid is an old friend of Explained and one of our most valued experts. He's been the expert on several other Explained events. Sajjid, welcome. Thank you for your time. We are honored as always.
Good evening. Pleasure to be here.
Thank you, Sajjid. And speaking with Sajjid will be my colleague, Executive Editor International Affairs, P. Vaidyanathan Iyer. The way this event works is there will be an explanatory conversation between Sajjid and Vaidi for about 45 minutes or so, after which we will open the floor to a fixed number of questions from all of you, the audience. Thank you very much. And Vaidi, all yours.
Thank you. Thank you so much, Manojit. Welcome, Sajjid, and a very warm welcome to all the people who have managed to find time to log in to hear Sajjid. Sajjid, if we are talking, of course, about the budget, and it's been more than 2 weeks since Finance Minister Nirmala Sitharaman presented the budget. We know that this was a very different budget. We had one of a kind budget, which was after a pandemic, and we are still in the course of the pandemic. So the budget did some remarkable things in the sense that it has put forward certain reform measures which were not really talked about for years, and it also kind of did not take a very disciplinarian view of the fiscal position of the government of India. So in this context, while we talk about, say, recovery in India, we also have what is happening in the rest of the world. IMF has, the International Monetary Fund has, gone through, sharp upgrades for the global economy. China itself, is projected to grow over 8%. And US too is looking at, IMF says that it will grow over 5% in 2021 against a contraction of 3.4%. As far as India is concerned, Sajjid, we have also were surprised by the upside in the economy. After the first quarter contraction, a sharp contraction of almost 24%, it was not so bad in the second quarter. And we are looking at a 14.4% nominal growth rate. That was what was projected in the budget. So if you can just lay the ground in the global context, how do you see India?
Thank you, Vaidi. Good evening. Lovely to be back. So I think this is the right place to start to understand what the global context is. And I think the news is much better to report than when we last spoke in October. The fact is the second half of 2020, helped by a lot of policy stimulus in developed markets, helped by very accommodative central banks around the world, was much stronger than the IMF had forecasted. And in fact, they've now marked up their 2020 forecast from a contraction of almost 4.5% to 3.5%, and they've marked up their 2021 forecast from a growth of 5.3 to 5.5. So the news is clearly better. We're seeing even more stimulus in the US now that we have a Biden administration. We never got a blue wave, but we got a blue dribble because it happened after some length of time. But you're going to get a big fiscal stimulus in the coming weeks. 1.9 trillion is not small on the back of already what's happened. We're seeing very accommodative central banks, including the Fed, which is determined to be very, very slow in unraveling its stimulus. And we've seen, compared to October, a record development of the vaccine front. So all of that has come together to make the recovery, to make the outlook a little bit better than when we spoke in October. But I think we have to scratch much below the surface. And what you will find is, despite the good news, which is predominantly in the US and in China, this is still a very incomplete recovery globally. And one metric that we must use again and again this evening in judging the pace of an economy's recovery is, how does the level of GDP at the end of 2022, for example, compare with its pre-pandemic path? The closer we're to the pre-pandemic path, the more complete the recovery is. And what you see is, yes, the US and China will have complete recoveries. China already has it. The US, we think, by the end of this year. But the global economy, despite this improved outlook, is still going to be about 4 percentage points below that pre-pandemic path, which is big. To put this in context, 150 economies will see per capita incomes in 2021 lower than their 2019 level. By 2022, that's still 110 economies will see lower per capita incomes than their 2019 level. So this is a big hit around the world. But I think from India's perspective, what matters is some of the tensions that will be created by divergences. You're seeing a lot of divergences globally, geographically, sectorally, intertemporally, across factors of production. Very strong growth in the US and China, much less so in other parts of the world. A very strong growth in the goods sector, much less so in the services sector. Very strong growth for profits, much less so for labor and for wages. And one of the reasons this may create some tension is, normally when you have strong US growth, you tend to have big spillover effects to the rest of the world. And when you get a synchronized global recovery, the dollar tends to weaken. And that's good for emerging markets because capital flows come into emerging markets. If you, however, get US exceptionalism, because the stimulus is so large and the US grows much faster than many of its trading partners, because a lot of this spending, Vedi, is going to be in the non-tradable sector. It's going to be opening up schools. It's going to be healthcare spending. Right? It's going to be services spending where people haven't spent. So the spillover of that to the rest of the world could be lower. That means you get the US growing much, much more strongly than the rest of the world. And if that happens, you can get a stronger dollar if you get this US exceptionalism. Now, if you get a stronger dollar and you get stronger oil prices like what we're seeing right now, then that creates an uncomfortable twofer for many emerging markets, including India. Let's hope that's not the base case. Normally, the dollar and oil tend to move in opposite directions. But you could have this strange situation where, given the global reflation, oil prices keep moving up. And if there's US exceptionalism, the dollar could strengthen. And we need to be mindful of those kinds of tensions, despite the fact that the global economy is doing much better than we thought 6 months ago.
Yeah. So, Sajjid, brilliant. I was just thinking that, coming back to, say, the budget, while we are seeing what is happening with the rest of the world and what is, how, say, US exceptionalism and oil prices will impact growth. Tell us in the budget, while we look at the projections of the budget, be it the revenue or be it even the implicit assumption that the budget makes on inflation, do you see they being realistic?
So this is one budget where I think the numbers are actually quite conservative, and I'll tell you why. Normally, we have a situation where we're always worried whether budget targets can be hit, and we're worried about slippage.
Yeah.
But let's start with FY21.
Yeah.
And what the budget presumes is, even for the RE targets to be met this year, that taxes net of excise was a big source of revenues, higher oil duties, but net of oil revenues, the RE targets are so conservative for this year that the rest of taxes have to contract by 20% in the January, February, March quarter to meet those targets. Yeah. These taxes grew 25% in the last quarter. Right? So my sense is we could actually get an upside surprise for this year itself in the FY21 RE number. Yeah. Now that's important because if the base for taxes is higher this year, then the asking rate that's required for next year's tax number is going to be lower. So again, if you take excise out of the picture, the tax buoyancy that's assumed to get to next year's number is actually 0.8. It's less than 1. So I actually think one of the kind of paradigm changes that I've spoken about, and there are a lot of execution issues we should talk about, but one of the paradigm changes is that you're seeing a lot of conservatism, welcome conservatism on the revenue side. So I think the tax buoyancy is not very ambitious. I actually think we could be surprised to the upside in terms of GDP growth as well. Not because I want to make any heroic assumptions, but if you just look at the quarterly trajectory of growth, and if you even presume a 4.5% quarter-on-quarter annualized momentum, which is how most analysts forecast growth, then the full year number for 21-22 could be as high as 13% or 13.5% real GDP. To put a deflator of 3 or 3.5%, you may end up with a nominal GDP of 16 or 17%. This doesn't mean India is booming. This will still be an incomplete recovery. Even if we contract 6.5% this year, which is our base case, and we grow 13% next year, India will still be 4 to 5 percentage points below its pre-pandemic path. There's a lot of scarring that I'm sure we'll talk about. But just in terms of the budget numbers, I think both the nominal GDP assumption for next year and the estimated tax buoyancy are quite conservative. That's a good thing to have, because when you have a big disinvestment asset sales target, it's good to have a little bit of buffer in terms of tax revenues. The other risk, of course, is oil prices. Oil keeps moving up. That creates some pressure on the fiscal math. So I think generally the math is quite conservative.
So you would say that the as revised estimates for 2020-21 of fiscal deficit, which was estimated at 9.5%, might be lower, and which might actually give you more fiscal space in the following year. Would you say that?
That's right, Vedi. So this is I know you're surprised, because this is exactly opposite to how we're used to thinking. In recent years, we always worry that the RE might slip because the last quarter revenues don't matter. We actually think that the upside surprise to revenues could be as high as 0.5% of GDP. So in May, when the CGA numbers come out, it's possible that the deficit this year is closer to 9, not 9.5.
Yeah.
Right? And one of the reasons why it was different from the 7% that most analysts had predicted was about 1.7% of GDP in terms of food subsidies, which most people had forecast would be on FCI's balance sheet, came back on. So once you adjust for the conservatism in revenues and the food subsidy, you come back quite close to 7%. It also means the consolidation next year, it's supposed to go from 9.5 to 6.8, is really not as heroic as it looks, which is a good thing. Because if we end up at 9, and a lot of that was because of one-off in a payment of FCI arrears or fertilizer arrears, what you see in the B numbers is that subsidies itself come down by 1.6% of GDP, because there are many one-offs this year. So that directly means that this year's deficit, net of those, looks closer to 7.4. So you're really going from 7.4 to 6.8. So I think we need to welcome the fact that there's been realism and conservatism, I think, on the deficit path and on the revenue path.
Yeah. So one thing which which many people do point out is about this FCI's dues being brought upfront in the budget numbers. So in terms of the real increase in expenditure, so to say, is not really much, is what the critics would point out.
So again, to look at that, and you're exactly right, because there's a lot of movement in subsidies off balance sheet, from balance sheet. So the metric that I like to look at is look at total expenditure, but take out subsidies and take out interest payments, which are non-discretionary. If you take out all subsidies and interest payments, and let's go back 3 years, what you will find is that expenditure to GDP is typically about 8%. Now, what folks often don't realize is even in the pre-pandemic year, in 2019-20, spending grew 20%, which nobody quite realized because those numbers came out in May in the fog of the pandemic. And that ratio of 8 went to 8.9. Now, in the pandemic year, that 8.9 has gone to 10.8 in the RE number. Some of it is because the numerator, of course, grew about 14%, but some of it, to be fair, is the denominator contracting, so the ratio goes up. Next year, you're right, the 10.8 comes down to 10.3. So net of subsidies, expenditure to GDP, net of subsidies and interest, falls by 0.5% of GDP. But 10.3 is still a pretty expansive fiscal stance, because it's much above the 8% that happened pre-pandemic. So the way I think about this is there was about 3 percentage points of stimulus put in 1 year before the pandemic and in the pandemic year. 0.5% of that is being withdrawn. Now, this is where I think, I'll just make one last point in terms of fiscal impulse, which is what you're getting to. I think this is where execution becomes so important, because what the budget's banking on is that capital expenditure picks up. 1.7% pre-pandemic went to 2.3 in the pandemic year, 2.3 goes to 2.5. If we can get that capital expenditure, this in FY22, the multipliers are very high, typically. So even though revenue expenditure is going down and capital expenditure is going up, the fiscal impulse could end up being positive if we can execute the capex, which is why execution of capex becomes so key.
Absolutely. I was just comparing the numbers of 2019-20 with 2021 and then, the next year. And you could actually see that, the capital expenditure, which, everybody pointed to as having risen sharply for the next year, it was high even for the previous year, that is 2021. So that's something which you kind of really explained it so well for us. But again, now the another critical thing which many people point to is the capital expenditure growth, which the budget seems to have created extra fiscal space for. How does it kind of compare in terms of what it could mean to growth had it been in terms of, say, cash support to the people who are really stressed, and also to SMEs which are finding it still difficult to kind of have to get credit from banks, and probably are facing one of the worst situations.
So permit me a couple of minutes to answer this. I think it's good to set the macro backdrop for why fiscal policy has to be expansive going forward, and then to understand, if you make that choice, how should one trade off capital expenditure versus income support? If you're a developed economy, you have the luxury of not trading that off. But I'll just come to that second. I think the first thing is to understand, why was it so important for fiscal, or is it so important for fiscal to do the heavy lifting? Because the easy answer would have been to just, believe these numbers and say we're growing at 13% next year. The bond market would like a lower deficit number, and the error would have been to just slash the deficit next year, from 8% to 6% next year, and do that without actually budgeting higher asset sales, but budgeting more tax buoyancy, right? And I'm glad we avoided that. It would have been the easy thing to do, but in my view, the wrong thing to do. I'm glad that fiscal policy is going to be supportive for the near term, for a very simple reason. If we just look at growth before the pandemic, where a lot of it was driven by consumption, but a lot of that private consumption growth was driven by households running down their savings and taking on debt. And therefore, even in the year before COVID, you saw that private consumption growth had slowed from about 7% down to 5%, which was the lowest since the global financial crisis. So household balance sheets were already getting a little bit stretched coming into this crisis. Now, once you have a meaningful income hit, it's even more likely that households are going to remain risk averse, precautionary savings will go up, and they will not spend in a hurry or borrow to spend for sure in a hurry. And one important data point on this is just 10 days ago, when the RBI released its consumer confidence surveys, everybody was focused on the headline confidence number going up. But the really important number is in that survey, when you ask households, what are your expectations 1 year ahead of income? People have better expectations now than 3 months ago on the economic environment, on income, on unemployment. And yet, when they asked, how will your spending be 1 year ahead? It's much lower than they were budgeting 6 months ago or 9 months ago. So expect there to be a natural consequence of this shock, for there to be high levels of risk aversion by households, given the hit to their balance sheets. Now, if the consumption recovery is going to be uncertain, and right now we're enjoying the benefits of the pent-up demand from the upper end of the income spectrum. These are folks that can work from home, have had their incomes protected, savings rates have been forced up. So they've got fuel in the tank to spend, which they are in the next couple of quarters. But this is a one-time phenomenon. When that gets over, you will see that the households that have actually experienced income losses and job losses and the labor market scarring, which is very visible, will then show up in the form of a more gradual recovery in consumption. So we should not expect that consumption growth is going to bounce back to its pre-COVID levels. Now think of investment. Investment utilization rates were below 70% even pre-pandemic for 3 consecutive quarters. In the pandemic, those utilization rates have come down to 63%. Investment, remember, is endogenous to final demand. If the consumption recovery is going to be uncertain, if exports are going to be uncertain for the reasons we mentioned, then it's unlikely to expect private investment to pick up anytime soon. So, since this is an explained event, it's good to just step back and say, if you look at GDP from the expenditure side, it's consumption plus investment plus government spending plus net exports. If net exports and consumption don't have much conviction, hard to expect investment to pick up, which is why government spending will have to do the heavy lifting. So I think the first thing to appreciate is the reason it's important for the government to still support the economy in the near term is because the other drivers of demand will take time to recover and will take time to heal, like it is in other parts of the country. Now, I'll answer your question in a second. So if you step back, what is the budget strategy? I think it's very much push capital expenditure hard. And I would say you have to take a 2-year perspective on this. Look at FY22 over FY20, and you'll see capital expenditure has gone up by almost 1% of GDP. And I think the thinking there, and one that, on the last event I pushed hard for was that if there's a big public investment push, it immediately boosts aggregate demand. It has large multiplier effects. So it crowds in private investment. It creates construction jobs. So it helps fill some of the jobs gap. And it improves your economy's competitiveness in the medium term. And I think that's the focus of the budget, that let's try and crowd in private investment to higher public investment. Now, your question is a very good one. What about income support? And a couple of things. One is, at least in the rural economy, we have NREGA. The demand for NREGA remains very elevated. Even in January, it was 40% higher than the previous January. So at a minimum, what we need to do is that demand should be fully serviced. And I think even though the budgetary allocation is lower, this is a demand-driven program. So hopefully as demand for NREGA, hopefully it doesn't remain high, but if it does, it's good to fully service that demand and the allocation should go up. But very, conceptually, when it comes to urban poor, even though we may agree that income support may be necessary, targeting becomes a little bit of an issue. How do you target the urban poor, right? How do you ensure that the money reaches the right hands? When it comes to SMEs, given employment is so informal and a lot of it is self-employment, unlike the US, which can just increase unemployment insurance because all the labor there is formal. In India, given the informality of the market, it's harder to reach the urban poor. Rural poor, we can reach through NREGA. Similarly for SMEs, how do you ensure that money reaches the right SMEs? How do you ensure that they use that money to not lay people off, which is the whole point, that you want to give them support so they don't lay people off. So I think one of the challenges in emerging markets is targeting, monitoring, information is hard to get. And I think therefore the approach perhaps is you provide a lot of credit guarantees early on so that these SMEs can stay alive through the crisis. But now as the economy opens up, their viability will come down to demand. It's going to come down to if aggregate demand is strong enough, then the SMEs will be viable. If it's not strong enough, they will not be viable. So I think as the economy has opened up, now we need to go back to boosting demand. And again, the hope is that the capex push with its multiplier effect hopefully will boost demand if we can execute it. Similarly, I think on the jobs front, we now need to start moving from income support to job creation. That really, your income support you require for the first 3, 6, 9 months. Now, if the scarring is going to be permanent, 3 months or 6 months of income support may not be necessary. You have to boost demand so that you create jobs. And frankly, it's the certainty of a job that will reduce the precautionary savings that I spoke about. So again, no easy answers. I want to be agnostic about this. In theory, we should be doing income support also in addition to capex, but in emerging markets, targeting, execution, implementation, information is hard. And therefore, one has to live with second best. But at least at the bare minimum, what we now need to do is make sure the NREGA demand is fully serviced through next year, and also ensure that we actually deliver on the budgeted capex. Hopefully that will boost demand. and create jobs eventually.
So you're saying, even now when you're looking at, CMI numbers of, say, those who have been out of jobs, it is, close to 1 crore people. And you're right when you say that, it is very difficult to kind of target in urban areas where to give cash or where to, direct your support for. But there are always solutions for that. Like, I have been all of us have been reading stuff, and you do see that municipalities can be an effective vehicle to kind of pinpointedly target in large metros which have got huge services industries. uh, so probably it is also more of a political call. Would you say that to look at capex driven growth rather than say a cash support to a large section of people, distressed people?
Well, I think one is more relief, one is more kind of stimulus. Ideally, you want a mix of both. I think the capital expenditure, though, very is important. The reason I'm emphasizing this is, given India's growth dynamics in the last 3 years, and given the global economy, we've discussed this before, that investment to GDP, gross fixed capital formation, is down by 5 to 6 percentage points over the last 6-7 years. And really, if we want to get into a virtuous cycle, it will have to be investment-led growth.
Yeah.
I think of the 2003 to 2010 cycle. You had high, strong exports. It led to private investment. Investment led to jobs. Jobs led to higher income. Income led to consumption. Consumption was an outcome of income and jobs. So I think we have to have investment-led growth. And in this environment, you will need some kind of Keynesian public investment push to boost animal spirits and to crowd in the private sector. So I think that is necessary and inevitable if you're looking at a growth trajectory over the next 3 years. And that is unavoidable. That it's hard for me to imagine that private investment pick up if public investment remains very muted. And I think this is equally true of the states. We focus so much on the center. The bulk of capex happens in the states. So it's important that states have the resources and the wherewithal to also ensure they're not cutting down on capex in the next few years. So I would think from a growth perspective, that's really important given its large multiplier effects. And I'm hoping that creates jobs, which then provides the relief.
My last question on this, Sajjid, and I would love to move on, is what is the flip side or the downside risk to this capex-led growth? Is it, as you pointed out, is implementation on the ground the most critical aspect of that?
It is most implementation. It is the most important part. There are always execution risks and implementation risks with capital expenditure. We've actually in the past seen in certain areas, roads, for example, have done well. So if you look at where the spend is in the last 2 years, again, look at FY22 or FY20, a lot of it is in highways, a lot of it is in railways, a lot of it is in urban housing and urban infrastructure. So execution, so for me, the design of the budget was the appropriate design given the macro environment. The key challenge is going to be execution. So I agree. Not just execution on the capital expenditure side, but execution on the disinvestment side and the asset sale side. Because I think of this as an asset swap. That across a 2-year period, capex has gone up by 0.8% of GDP, paid for effectively by a 0.6% increase in asset sales. So we have to deliver on those asset sales to generate the resources to ensure the capex gets done.
So that brings me to very logically to the next question on asset sales itself. Basically, the budget did talk about asset monetization plan. It also talked about privatization for the first time in 6 years. Privatization as a word in the budget has been introduced of public sector banks and a state-owned insurer. So how do you look at these announcements? And do you see that given the uptick that the market has seen, even since the budget, has been very sharp increases in the indices, both Nifty and Sensex, do you see as the right time to push through disinvestment? Or what is it that could kind of hold government back?
No, that's a great question. And I think just to step back and, to reconstruct the forest from the tree, so to speak, if you just look at all the announcements in totality, again, I think of this as a reimagining for a reorientation of the public sector's balance sheet. That on the one hand, we want to start selling some assets, and then use those resources to build new assets. So this is not like selling your family silver to pay your credit card bill. This is, I would say, a reorganization of your balance sheet, kind of a productivity enhancing asset swap. Now, of course, this is good in design. We actually need to execute this. And I would say I can't think of a better time, given global liquidity, given the buoyancy of asset markets, for us to sell these assets. Right. So it would be important to front load this, to do this as soon as possible before global central banks become a little bit more cautious and some of the buoyancy we're seeing on global liquidity abates. Secondly, I think it'll be good to just have a systematic way of doing this. I don't think the focus should be necessarily on maximizing revenue. I mean, I don't think we should try and aim to time the market. I think just as households are told, have a systematic investment plan. Right, you win some and you lose some. I think perhaps the government should take a more kind of institutionalized mechanism, that we take a more systematic plan. We have a regular stream of assets we sell. Some will fetch very good valuations. Some may fetch less, slightly lower valuations. But it kind of all averages out. And I think we have to see the value of this not from the revenue that each asset generates, but that A, it allows us to do the necessary capital investment that we spoke about, and B, there's a huge efficiency enhancing component when you do a strategic sale and this asset, which could be distorting incentives in that sector, moves to the private sector's hands and can generate, and who can generate some value. So it is a big task. I would hope, given the urgency of the macro environment and the imperative of fiscal policy, I'd expect that there's a seriousness about this privatization and these asset sales. And I think having an institutionalized mechanism and changing the incentive structure of the people that are conducting this will be an important prerequisite to its success.
Right. Say, for instance, even this markets, since it is broadly, markets are linked to the economy. And so how much of it is like inherent belief in the growth story that India presents to investors, and how much of it is say global liquidity, flush of global liquidity that we are seeing now?
Being an economist, thankfully, I don't have to deconstruct the rationality or irrationality of markets. Let me just give you one number, because this is a phenomenon that we're seeing right through the world. Right, it's happening in all asset classes, equities, emerging market currencies, credit. Here are some baffling numbers. If you look at G3 central bank balance sheets, these balance sheets were about 10% of GDP in about 2007. By 2010, when the QE started, 2010-11, they've doubled from 10% to 20%. Then between 2011 and 2020, when there was no global crisis and this was peacetime, they doubled again from 20% of GDP to 40% of GDP. And then in 1 year, in the COVID year, they've gone from 40% to 60%. When G3 balance sheets increase by a factor of 6, in a matter of 13 or 14 years, you are going to see, this liquidity and see crazy kinds of valuation. So I'm not for a moment saying that this is not that economic prospects are not improved. In India, prospects have certainly improved compared to 6 months ago. They've improved around the world. But it's fair to say that a lot of this is being fueled by this unprecedented expansion in G3 balance sheets. And I think central banks need to be careful, because these volatile flows come in on a whim and often go out on a whim. And so many emerging markets, we need to self-insure. Previous RBI governors have spoken about this, manage the spillover effects of all of this liquidity.
Yeah. So you would say that, India has to be watchful as far as the markets are concerned? Would you say that India has to be cautious? India has to be closely observing this? Is there a downside risk of?
Yeah. Well, again, I wouldn't want to comment on markets per se. I don't think we should judge the state of the economy by markets. I think around the world, there's a huge wedge between market valuations and where the underlying economy is. I think on things like capital flows, I think we're doing the right thing. There's a huge ton of capital flows coming in. The balance of payment surplus in 2020-21 would be about $90 billion.
Yeah.
Because we ran a current account surplus, we had strong capital flows. And it was important, I think, from a competitiveness perspective, not to let the rupee strengthen.
But as an economist, sorry, please go ahead. As an
So
economist, sorry, please go ahead.
So just to say, it was important not to let the rupee strengthen. And I think the RBI did the right thing by intervening very aggressively in the FX market to ensure that India's real effective exchange rate, does not strengthen, because that will just impede the competitiveness of the tradable sector. So we need to be mindful of those global spillovers and capital flows in terms of not distorting, exchange rate fundamentals, for example.
So, as an economist, looking at global markets and looking at central bank balance sheets of the G3, do you have a peaceful sleep, thinking that this is fine, a 6x increase over 14 years?
No, that just doesn't sit. That doesn't sit well on me, because I see the gulf between economies, the real world around the world, the real economies around the world, and asset markets this is an unprecedented gulf. And part of it is because the nature of COVID, what COVID has done is essentially trigger a redistribution of income from the bottom end of the pyramid to the top end of the pyramid, from labor to profits. Around the world, we're seeing a very strong profit-led recovery. And I think this is the tragedy of what's happening, that, labor is taking it on the chin, and companies are making record profits.
Exactly.
Just look at India's last GDP number of minus 7.5, and I'm only using India because I'm familiar with the data. This is a prototype for other emerging markets in the US in particular. Because it's an explained event, there's a third way to compute GDP, which is the income side, which is the sum of all operating profits and all wages, right, and indirect taxes, right? So the wage bill, the profit bill, indirect taxes. Profits in that quarter in real terms grew between 25 and 30%. If profits are growing between 25 and 30% and GDP is still contracting 7.5%, it just tells you what's happening. I'm talking about listed company profits. It tells you what's happening to unlisted company profits, the SMEs, and to labor. And this is true in the US as well. So there's some rationale for why markets are doing very well, because profits are doing very well. But we should not for a moment glean from that what's happening in the labor market or in the real world, which is why fiscal policy around the world will have to play a very important role. Monetary policy is a blunt instrument, and to the extent that it sometimes even fuels this higher inequality, because lower interest rates will, all else equal, result in higher valuations and maybe drive a more profit-led recovery. So fiscal policy has a really important role to play, but India should use this to its advantage to sell its assets at these valuations and plow those resources into the real economy. Yeah,
that's probably where the critique comes on, on the fiscal stance itself, not on the fiscal stance, but on how you spend the money, whether it goes to people who are in huge distress and SMEs which are in great distress, or to capex. But say one of the things
just 30 seconds there, Vedi. Again, I don't mean for a moment want to underplay the distress. As you said, if you look at the CMI data, you hold the labor force participation rate, right? The labor force participation constant. The unemployment rate's gone from 7.5% to about 12%. Demand for NREGA is up, by 40%. I guess the question only is that A, how do you target a very informal economy? And B, I think we now, as we recover from COVID, we have to move away from income support to job creation. And the question is, without private investment, we won't get the job creation. When you get the job creation, that A, you help livelihoods, but B, the certainty of that income from a job stream, as opposed to 3 months or 6 months support, reduces household precautionary savings. It's a difficult balance.
The other thing which we talked about, which you referred to in the beginning, is about oil. Oil prices are suddenly firming up, 60, 67, 63, $64. I haven't kept very close track, but oil prices have gone up, and this has two different impacts. One, of course, it increases your fiscal burden, because we are three-fourths of our requirements are met through imports, and also in inflation, because fuel constituent in the CPI basket does mean that inflation would go up. So how do you look at its impact down the year?
So, India being a large importer of oil, there are huge terms of trade changes when oil bounces around so much. And in the past, we've been a beneficiary of these terms of trade changes. For example, the collapse in oil prices in the COVID year and the excise duties that were put on has garnered the government, 0.7% of GDP this year, which is not a small number.
Yeah.
Ironically, in a year where you had the largest economic contraction ever, gross taxes to GDP actually higher than the previous year, right? In part because you've got this oil bonanza. Now, as oil prices move up, we'll have to make difficult choices. One is going to be, do you cut excise duties to avoid retail prices from not going up? But then if you cut excise duties, then there's a hit to revenues. Does that then mean that you have to cut capital expenditure, which could be more focused, on creating jobs, for example?
Yeah.
So I think these are difficult choices. There's no right answer. I think perhaps what we need to do is balance the cost. It should be shared across all stakeholders here. That beyond a certain point, letting retail prices flow through actually could impact inflation expectations, and you don't want inflation expectations to go up very sharply, especially since food prices for much of last year went up and they affect inflation expectations. So I would say there's no easy answer. Perhaps we want to balance out how much of this is absorbed through higher increases, retail increases, which helps preserve revenues and generates more expenditure, and how much of this is excise duty cuts, which keeps retail prices capped. I think at some point we would need to share that burden. Of course, the third impact is on the current account, and India will be seeing that we're moving from a current account surplus this year of 1% of GDP to a deficit of 1% of GDP, which is not threatening, but that's a 2 percentage point swing. And if you step back and look at general equilibrium macroeconomics, what that also tells you is that the extra savings that you got in the COVID year, which helped get the government's borrowing program through quite easily, right? The RBI did not have to monetize government borrowing at nearly as much as everybody thought. They only bought 15% of total issuance, which is what they buy in a normal year. But this year, if you're running a current account surplus, what that means is the private sector savings investment balance will adjust, savings will normalize, investment will go up. That's a healthy thing. But that will also have implications for what the equilibrium interest rates are in the bond market. So this is a very complicated phenomena, and high oil prices going up affects all parts of the economy. Fiscal balances, current account, it'll have some impact on savings investment and also on inflation pressures. So let's hope that you don't get a very big pickup in oil prices, because that severely reduces macroeconomic degrees of freedom. One last thing I'll say, I think another lesson for the future perhaps is India should also start institutionalizing some hedging mechanism. That if you start hedging oil prices, then when they begin to fall, you can capture some of those benefits, and you can insulate yourself from these huge swings in oil prices. That's again something to think about for the future.
Yeah. So critical to this would also be the monetary fiscal policy coordination, right? In the sense that how at a time when India is looking for higher growth, and if inflation does seep in, whether the RBI can maintain its accommodative stance. So that would be one of the most critical factors going ahead.
Absolutely. So I think getting the fiscal monetary mix right will be very important for the sustainability of the recovery. RBI was the prime mover in 2020. Lots of rate cuts, lots of liquidity, lots of forbearance, like other central banks. Now fiscal policy has picked up the baton, which was the right thing to do. But now that fiscal policy has come to the forefront, I think it will mean that the central bank needs to perhaps step back a little bit. We've had exceptionally accommodative monetary policy, and I think over time you want to gradually withdraw that in a very non-disruptive manner, because you also want to get the government's borrowing program through without a big pickup and without a big tightening of financial conditions. So I think now, as the baton has moved to fiscal, the RBI needs to just step back and in a gradual manner begin to normalize. As the recovery gets more entrenched, you want fiscal and monetary policy to become substitutes, right? During a crisis, you want them to be complements.
Yeah.
But as the recovery gets more and more entrenched and be more confident of the recovery, you want fiscal and monetary to become substitutes so that you avoid any financial stability concerns down the line.
Yeah. So before I request the audience to come to have their questions addressed to you. One last thing, Sajjid, is on this the PLI scheme, the productive linked incentive scheme, which is almost like, if I'm not wrong, something like two plus lakh crores over the next 4-5 years. How do you look at that? Because over the last 3-4 years, also we have seen increase in duties across various sectors, or be it say electronics, air conditioning, all those areas. Do you see that at a time when, say, there is huge, given the IMF upgrades of, say, US, China, do you see our exports getting hurt? Do you see that this self-reliance or pushing the domestic industry will, on one side, kind of cost the consumers, or would it mean that we are closing our or we are kind of precluding a lot of imports? How do you see it?
Yeah.
Look at that.
So we're still awaiting details of the PLI scheme. I'm just going to step back and make some more general comments. I think it's really important that in the medium term, exports drive growth in India, because we've not seen any emerging market grow at 7 or 8% for any length of time without export-led growth. And that last burst of growth we had between 2003 and 2011 was all export-led. So I think it's really important for exports to drive growth going forward. And I think so the focus really needs to be on how do we join global value chains. And these value chains are going to change in a post-COVID world. You might find some of these value chains are becoming shorter, but the fact is they're still the primary manner in which you can improve your global export share. And India's export share is small, it's just 1.7%. So I would say that joining global value chains and boosting exports becomes key. The foundational theorem in trade theory is kind of an import tariff is equivalent to an export tax. So we need to be careful on that front. To the extent that we can get firms from China to come to India and then set up forward linkages and backward linkages, which allow us to join global value chains, I'm all for that. But this needs to be kind of, an export. Ultimately, when in a couple of years, when the economy stabilizes from the pandemic, we have to again rely on exports as being a driver of growth, simply because no country has been able to grow without export-led growth at 7 or 8% for close to a decade. I'll just say one more thing. There's a lot of work we have to do in preparing ourselves for that. And one of the things is just size of our firms to compete in the global markets. You need larger firms. There's a great example in 2005 of the apparel industry, where Chinese real wages were rising, and that we thought that business would come to India, but it went to Sri Lanka, it went to Bangladesh, it went to Vietnam. And part of it is, if you look at the apparel sector, 92% of people in that sector, this is 2005, but I'm not sure things have changed very much, were working in firms that had less than 20 employees. So these were littered small firms.
Yeah. And
in China, 57% of people in that sector were working with firms of more than 200 people. Yeah. So really, to succeed in the global front, apart from infrastructure and some export incentives, we also need to reorganize our industrial structure and ensure that we've got larger, more formal, more productive firms that can compete in global markets.
Yeah. May I now request Professor Hemant Nanavati from IIT Bombay to ask his question? If you can, please unmute yourself, Professor.
Halter. Yeah, can you hear me now?
Yeah.
Okay.
Yes. First, being a physical scientist, I understand and really appreciate what a social scientist has to deal with. The economist in you, Sajjid, you have to deal with people as well as concepts. And so I also appreciate the fact that you talked about the limitations of implementation and having to deal with the problem of how do you help the smaller scale industry where people use their own money and employ people with their own money rather than money that they have borrowed? And again, when you want to help, I think the way the budget seems to want to help the SMEs has been to help people who have taken loans and not people who have used their own money. And towards the last part, you talked about that you want to have, for competing at an international level, you want to have more and more of larger SMEs, where the average is 50 plus employees and not 10 employees. But for that to happen, it is the existing small companies that have to grow.
Yes, yes.
And not just help just the existing large companies, because the small companies are I think the jargon is wealth at the bottom of the pyramid. And so in that sense also, I appreciate your fact that the problem is in implementation. How do you help them? Because you have no way of knowing who they are. And I think Vaidyanathan mentioned that you can talk to the local municipalities. But one problem there again is implementation, because when you have to deal with people talking at the lowest level, you are talking with the highest level or a very high level of corruption at a day-to-day level in India. Like most forms will only proceed if there is a right paperweight on it. So that is a real problem of implementation. And I think the economists probably need to work with maybe sociologists, I guess, to come up with solutions that are more implementable, not just something that should be done that deals with the numbers. Because you want these wealth at the bottom of the pyramid. By definition, the bottom of the pyramid contains the most number of people. And these are people, not statistic. So what would you think would be the way? Because the way in what you talked about in the budget is clearly said, raised his hands and said, I can't help you when it comes to helping the people at the bottom. What do you think would be the way going forward? Because you are also a part of the Economic Advisory Committee. So how would you suggest be the way going forward to actually combine implementation or implementability to because you're talking about not just Manrega or Enrega where you're talking about rural, you're also talking about urban sectors. So something that is implementable, how would you adjust to help people who are using their own money and who have lost their own money?
Thank you, Professor Anand. These are excellent questions out there. And I think implicit in your question is the fact that there is no easy answer here. Just a couple of conceptual responses. One is, you're exactly right. What we want is an ecosystem where small SMEs over time organically become bigger and become, competitive regionally, nationally, and then globally. Because at least the data that's available suggests that, in these very small SMEs with 5 and 10 employees, productivity levels are lower. When productivity levels are lower, wages are lower, right? So we want to remove any impediments, whether it's credit, whether it's labor laws, improve infrastructure, improve power availability, to ensure that a economically viable small SME grows. And in fact, post-COVID is going to be a very important period, because there will be a lot of creative destruction around the world. New sectors will arise, some old sectors may become redundant, and the nimble economies are ones that will allow this creative destruction to happen, but yet in a manner where you've got a safety net to absorb the fallout. So I agree with your point that you want the SMEs, the smaller SMEs to grow, and you have to create an ecosystem for that. I think for SME viability, again, I think there are two different concepts and we shouldn't confuse them. One is the credit guarantees that were given to SMEs, but again, you're right, only those SMEs that had outstanding loans, so that won't cover the people that didn't take a loan. But even for those SMEs, it was just to keep them viable, so they could pay their salaries, pay their bills while the pandemic was on, when nobody was consuming their goods and services. But now that we've come out of that and activity is normalizing, January, we're about back to 100% of pre-pandemic levels on average. This comes down to economic viability. So I think the budget's role really needs to be to boost aggregate demand. If aggregate demand picks up, that will flow through to large firms and small firms, and that's what keeps them viable. On the safety net issue, you're exactly right. I mean, everybody's contention that we need to provide better safety nets. Question is, how do we do that? And I think we need to go back to the drawing board to understand in the urban area, what kinds of safety nets do we have? We've already created the infrastructure of Jan Dhan Aadhaar Mobile. Maybe we need to use that architecture to identify the urban poor, find a pipeline to them so that the next time there's a shock, we can do that. I'll just make two final points. NREGA is a very important automatic stabilizer in the rural economy, and the temptation would have been just increase NREGA wages. But again, while that will provide more relief, what you don't want to do is to distort the incentive for some of the migrant workers to come back to the cities. Because if good jobs open up in the cities, you want them to come from the rural to the urban economy and resume those jobs. So if you keep increasing NREGA wages, you may distort that migration decision. If you set up an urban NREGA, then again, you might attract workers to urban areas where infrastructure is already, very stretched, and cities are kind of bursting at the seams. So therefore, you're right. This is all about implementation. We need to go back to the drawing board and figure out, we have something for the rural economy that works. How do we create an architecture for the urban economy to create a safety net the next time there's a shock?
Yeah. May I now request Mr. Anup Hivse?
Can you move to the next one?
Yeah. Can I request Mr. Rajiv Gupta, Professional Exim Consultants?
So please unmute yourself.
Mr. Gupta, can you unmute yourself, please?
Hello.
Yeah.
Sir, the premise is that Indian economy is doing well and poised to do well on a sustainable basis. And on this means the budget deficit for 21-22 is shown pragmatically at 6.8%, and borrowings of the government will be in excess of 10 lakh crores. Now, government has to fund GST liability with 14% growth, which is promised by the center to the states. Is this means fully taken care of, in your opinion, Sajjid? The second thing is that foreign exchange resources are in excess of $500 billion in this country as on date. Now, are we utilizing these assets of the country in a judicious manner to come out of this crisis? These are the two questions which I would like you to address.
Thank you. So, your first question is, I think what the center has announced is that the GST cess will go on for longer. And I think the compensation to states for years 4 and 5 will come out of that GST cess going forward. Just want to make one point on the fiscal deficit path. The center has laid out a path that's more relaxed than previously envisioned. And I think that's good to provide fiscal policy space. At the same time, I think that needs to be tied into the economic recovery. If we end up recovering faster, then I think we should also consolidate faster, just so that debt sustainability remains well anchored. I think on the foreign exchange reserves, I keep saying you can either target price or you can target quantity. If the idea is to keep the exchange rate competitive and not let it appreciate too much, because that not only hurts exports, it affects the viability and the competitiveness of the tradable sector as well, then one byproduct of that is going to be that the central bank is buying these reserves or buying these dollars in the foreign exchange market, and then we're investing that at very low yielding treasuries, and there's no way to get around that. The short point, I think, is that that is, in my view, a cost worth paying to preserve the competitiveness of the tradable sector.
Yeah. May I request Mr. Ankit Anand of Reliance Jio Infocom?
Am I audible?
Yeah.
Good evening, Sajjid and Vedin. Thank you for the brilliant explanations. This is kind of an off-budget question, but it relates to how we have been managing our debt and the uncomfortable discussions around that. You have been a part of the 15th FC yourself that has recommended, dismantling of the current FRBM Act and setting up of a new body that will come up with a new framework given the complexities in India. And we also have the uncomfortable discussions around the Public Debt Management Authority in place. So, how do you see these evolving now that then we have this transparency brought on the budget? And how do you see these structures coming up, especially, with the center and state coordination also being very important there to manage the general government?
Ankit, great questions. And I like the pun in your question about off-balance sheet. Well, debt sustainability is a huge issue, right? So we've thrown down the fiscal gauntlet, and debt to GDP, in our estimate, will be somewhere around 88 to 90% of GDP this year. Now, I think all the old rules are out the window with the crisis. And just to put this in perspective, where the global debt to GDP is going to be 100. So it's not that India is exceptionally large, but the key is going to be not the level, but the trajectory of debt to GDP. I think the first thing we need to do is ensure the debt to GDP doesn't keep rising, the debt to GDP stabilizes and then gradually comes down. And here I can't emphasize enough the importance of the denominator, growth. And we've had this discussion before, that if India were to grow somewhere between 6.5% to 7%, even if the fiscal consolidation is gradual, debt to GDP will stabilize and eventually start coming down. If India's growth, unfortunately, were to average 5%, for example, over the next 5 to 6 years, even if you bring the deficit down sharply, debt to GDP keeps monotonically rising. And that will then have implications for ratings and investors. So now that we've thrown the fiscal gauntlet down, we really, I think, as I said, all stakeholders really need to deliver that, 6.5%, 7% GDP growth year after year. And which is why, Vedi, I think, the capital expenditure is important, because that, with its multiplier effects, hopefully should deliver higher growth. Yeah. I'll spend 30 seconds more on saying there were, I think, 3 important paradigms in the budget, apart from the fiscal math. One was this public investment financed by asset sales. The second was the transparency and conservativeness that we spoke about. But the third was infrastructure financing. Implicitly, what we're saying now is the public sector will build the infrastructure, right? And when the infrastructure is economically viable and operational, then downstream, you sell that to the private sector, you recycle that asset, and then you use those resources to build the next project. And that is conceptually completely the opposite of the PPP scheme, where the private sector had to do the upstream execution, which it was less equipped to do. So again, execution is key, not undermining that. But if we can get this infrastructure asset cycling model, and we can get the public investment, then we need that 6-7% growth to keep debt stable.
Yeah. May I now request Rajan Maurya, who's a research scholar with the Delhi School of Economics. Rajan, you have to unmute yourself.
I think it's the wrong Rajan that has been allowed to unmute. Can the right Rajan be allowed to unmute, please? Thank you.
All right. Can we move to the next one?
Yeah. May I ask Mr. Bhaskar Das of CIMA?
Yeah. Please unmute yourself, Mr. Bhaskar.
Yes. Are you able to hear me?
Yeah.
Yes.
Yeah. Good evening, Sajjid and Vedi. My question is very simple. Is this high kind of capex budget or infra budget, is this sustainable in the long term? And given that our track record of projects has not been really up to speed, what would be the impact 10 years down the line?
Bhaskar, it's a good question. There's no simple answer, but I think all of us would agree that there are huge positive externalities in infrastructure, in health, in education, in public infrastructure. I mean, I just think back to, back in 1999, what the impact of the Golden Quadrilateral did, right? To connectivity, to productivity, number of studies the World Bank has done, enumerating the manifold impact of that. So in principle, we're underinvested in infrastructure, physical infrastructure for sure, health infrastructure for sure, education infrastructure for sure. And this is an area, given the externalities, where the private sector is going to consistently under provision. So we absolutely need the infrastructure. The question is going to be, and this is implicit in your question, state capacity to execute it and ways to creatively finance it. And I think this asset swap that I've been speaking about for the last couple of years seems to be the most obvious way of doing it, where you sell less productive assets, assets in sectors that the government doesn't need to be in, where its presence is in fact distorting, that particular sector. You replace those assets with the much needed physical and social infrastructure. Now, of course, this is much easier said than done, but we have to get down this path. And I think, given the utilization rates in the private sector, given the state of the global economy, given the state of India's private sector, I think one can only expect private investment to pick up if it is crowded in through public investment. So I think for the foreseeable future, we will need public investment to play a lead role in the economy. And hopefully that at some point that leads to higher private investment. One last point I'll say is, I think as the economy normalizes, even revenues will need to be rationalized. We need tax revenues needs to go up. Indirect tax revenues, the Finance Commission spoke about this, are actually much lower in recent years. So we'll have to rationalize the GST. We'll have to rationalize direct taxes. We'll have to use those as more sustainable sources of revenue to drive the capital expenditure that's needed in the budget. So there's a lot we have to do, but we have to make a start, I think, by pushing on infrastructure, which is much needed at this point. And I think that needs to play kind of a Keynesian role in the economy in the very near future.
May I request Priyanshu Kumar, who's a student with Indian Institute of Technology at Varanasi?
We move to the next.
Okay. May I request Mr. Vinay Mehta, Pole Vault Technologies?
He's not there right now.
Okay. May I request Mr. Ashok Meena, the Secretary with the Government of India?
Yeah. So please unmute yourself.
Yeah, thank you very much, Sajjid and Vaidi. I have you gave a very brilliant talk, and the focus of the budget was explained extremely clearly by Sajjid. As you said, capital expenditure is the focus. Then states need to come on board to increase the capex. But I find that imposition of the cesses and surcharges instead of excise and taxes, particularly in petrol, which have been reduced, it will reduce the divisible pool for the states. And therefore, don't you think states' resources will decline, and that would reduce the capex by the states? And bulk of the capex coming from the states would actually neutralize the whole focus on the capital expenditure.
Mr. Veena, a very good question, and you're exactly right. That typically, state capital expenditure is much higher than the center, so it's very important that state capex complement the centers. And I think state fiscal positions tend to be more pro-cyclical. They're less able to be counter-cyclical. So we saw capital expenditure being cut in the first 7-8 months of this year as revenues came under pressure. The good news is, if I look at data for about 15 states in November and December, you're seeing some pickup in capex. You're right that we want to do everything we need to ensure that resources from the center to the state are free flowing. You're right that if I look at kind of the tax devolution That's come down in the last 2 years. But one piece of good news here is that if I look at the FY21 RE, and you look at the total transfers from the center to the state, so this is the tax devolution, the Finance Commission linked grants, and other centrally sponsored schemes, that actually is a share of gross tax revenues is higher than the last 2 years. So that's more like 62%. The year before was 56, 57%. Even FY22 BE is about 61, 62%. So I agree with your larger point that we want to make sure that states are not crunched for resources, because that will hurt capex. The good news is that these transfers from the center, higher CCS and a higher Finance Commission rewards is higher, but again, to offset that, this is more tied money. So when the total transfers are higher, the ratio of tied funds to untied funds has also gone up.
Yeah. May I request Sonali Mukherjee to ask her question?
Hello. Hello, sir. Am I audible? Hello.
Yeah.
Hi.
Sonali, please unmute yourself.
Yes, sir. Am I audible now?
Yeah.
Yes, we can hear you.
Yes, sir. I was asking about the privatization in the insurance sector. And is it a good move? Like, do we really need to privatize the PSUs?
So I think you're asking about the financial sector more generally, and I think that's an important question. We haven't touched upon that because we're talking so much from the demand side about boosting demand, but it's really important that when demand for credit picks up, we also have a financial system that is willing and able to support the recovery. And as Vedi will realize, just before COVID, we actually saw a lot of risk aversion in the financial sector. And the way I think about it is that there's a stock issue, there's a flow issue, and there's an allocative efficiency issue. The stock issue is the NPAs. And I think one thing we need to do is expedite resolution mechanisms. It will be good when IBC is back to increase the resolution as fast as we can from the COVID NPAs. The flow issue is one where we've seen reluctance of some public sector banks in particular to lend. And again, I think hopefully they should be given the resolution and growth capital so that reluctance goes away. And I think the incentive structure may need to be changed. So that hopefully will help alleviate some of the flow issue. But I think the larger issue is we need greater allocative efficiency. And I think the statement of intent from the budget on privatization of public sector banks is really important, because I'm not of the view that we need so many public sector banks and allocative efficiency is compromised. I think we need the banking sector to be reorganized. We need more competition, more efficiency, harder budget constraints in some cases. So I take that as a very positive reform. And I'm happy that we're using the word privatization more regularly here. Now, again, much will depend on when and how and the execution. But I do think financial sector is one of the sectors we need to reform soon and aggressively, because if India has to grow at 7% in real terms and 10% in nominal, 10% nominal growth, you need credit to be flowing at 12 or 13% year after year after year to support that 10% nominal growth and 7% real growth. And we need a financial system that is willing and able to do that. So I see that as a big positive. Again, subject to this all being executed.
Yeah. May I request Vikram Gehlot to ask his question?
Hi.
Hi, Vikram.
Am I audible?
Yeah.
Yes. Good evening.
Good evening. So my question was about the borrowing, and to an outsider like me, it seems kind of alarming that last year the number was at 18 lakh crores, 15 lakh crores this year. So won't the interest payments actually also lead to a subdued period of growth? Isn't it kind of inevitable, even if the capex has gone up by to an extent? It seems that, yeah.
No, it's a very good question, but this is one of the inevitable consequences of normalization, right? So think of what happened last year. You had, as you rightly said, 18 trillion of borrowing, central and state borrowing, and the sense was, well, the RBI will have to do a lot of QE last year because who will absorb all this borrowing? Remember, India is not part of a global bond index. Hopefully, at some point, we will become. So there is no passive flow of foreign money that enters the bond market. It has to largely be absorbed domestically. But in fact, as we discussed, the RBI had to borrow very little of that, had to buy very little of that because COVID saw this big surge in savings. Savings were forced to go up because people could not spend even if they wanted to, and precautionary savings went up. So the vast majority of that issuance was absorbed by the private sector. Banks bought a lot, and it happened with interest rates being very benign. If you looked at the short end of the yield curve, for example, interest rates were consistently below inflation, so rates were really negative. Now, as the economy begins to normalize, it's a healthy thing that you're getting some normalization in the bond market. As I mentioned, because issuance is higher and because savings will normalize, private investment should normalize, which will mean the current account goes from a surplus to a deficit. That should result, the forces that drive that will also be forces that perhaps result in a higher equilibrium interest rate. And you've seen short end rates already go up 1 year, 2 year, 5 year. But real rates are not high in India at the moment. If you look at the short end of the curve and look at where 5 rates are, and you look at the fact that inflation has averaged 7%, or inflation is going to average 4.5% to 5% over the course of this year, then you're not seeing strong positive real rates. Real rates are either still negative at different parts of the yield curve or zero or slightly positive. So I would see this as a healthy normalization that's reflecting the economic recovery. As the economy recovers and demand, consumer demand and private sector demand normalizes, we can't expect there to be negative real rates. In fact, I think it's dangerous for there to be sustained negative real rates in the economy because that leads to financial stability concerns down the line. So as long as the increase in interest rates is gradual, it's non-disruptive, I think that's an inevitable consequence of normalization. And I think a 30, 40 basis point increase in bond yields, especially when those yields are either at the rate of inflation or slightly below, is a cost well worth paying if in fact we can deliver on this higher public investment.
Can I request Mr. Vivek Datar, former project director at TIFR?
Can you hear me, please?
Yeah.
Yes.
Okay. My question, I think the couple of questions were probably already answered. It was a very nice presentation that you made. My question relates to science and technology investment. For any knowledge-driven economy, this has to rise. And we are below 1%. Now, how do you think this will pan out? Other countries like Korea are spending more than 3%.
So Datar, you're the expert in this area. I'm not. I will agree with you that just like health and education, knowledge, this is one where you have large positive externalities and the state should be making those investments. I don't know enough about the area to know why we're not. If this is a budget constraint, then it goes back to what I said earlier, that in the near term, we need to be creative about raising resources for these kinds of public investment. In the medium term, we need to rationalize taxes and tax revenues to ensure these crucial investments are made. And I think this also means over time, we rebalance the expenditure side away from revenue expenditures and towards higher capital expenditures of the kind you mentioned, knowledge, health, education, which have large multiplier effects. But that's a medium-term project, I would argue.
Can I request Mr. Garvid Zalani to ask this question?
Could you call it again?
Mr. Garvid Zalani. Garvid Zalani. Okay, let me move ahead if
right.
Mr. Ranganathan.
Yeah. So please unmute yourself. So could you please unmute yourself?
Yeah.
Good evening. My question is, given
Good
the
evening.
level of gross NPA in the system, which perhaps one could estimate close to about 20 trillion rupees, how would the growth be sustained in the future years?
You raise a very good question. And I think, therefore, I was trying to emphasize that whatever stock of NPAs results after COVID is done, it's really important that we do the resolution quickly. I think if there's one thing we've learned in the last decade about India's banking system is the sooner we do recognition of NPAs, the sooner we do resolution of NPAs, the sooner we do recapitalization of banks, the less the deadweight loss, the faster that banks are ready to lend again. So you're right. We don't know what those NPAs are going to be when all is said and done. We have a good system in terms of IBC. And I think what we want to do is create resolution mechanisms that will hasten and expedite this process. If you have this large overhang of NPAs on public sector balance sheets or private sector balance sheets, for example, that's certainly going to disincentivize these institutions from lending again. Now, the good news is that the private sector has raised capital in anticipation of some of these NPAs, and therefore, hopefully that provisioning will happen soon. It's important for the public sector also to get both the resolution capital and the growth capital preemptively so that they're in a position to lend quickly. It's a very important point to raise.
Sajjid, if you may just ask, follow on to that. The government did talk about asset reconstruction company and also an AMC. And what we heard was there were talks that the government would give guarantee to the securities issued by the ARC. So do you think that this could be very meaningful in kind of resolving the bad debt problem?
Let's see what the design of that is. I just await the details of how, because very often the structure matters a lot of how it's run, who's running it, what the incentive structure is.
Yeah.
And I would say that while it's a good idea to aggregate these assets and try and resolve them, the key is going to be resolution. Mm-hmm. That we really have to have resolution mechanisms, no matter where this is, on whose balance sheet this is lying. Ultimately, it's the resolution of that asset that's going to get the system moving again.
Yeah. May I request Yogesh Dilor to ask his question?
Hi, can you hear me?
Yeah.
Yes, Yogesh.
Hi. So I was reading one of your editorials in the Indian Express, and just a caveat, I'm not from the field. So I know very little about a lot of stuff that you've been discussing, but it's a simple, plain question. You said there's an intellectual shift in the way we do infrastructure that we can see from this budget. So I couldn't really grasp as to what exactly was the conversation about. Is it just about the asset reallocation that we're selling off PSUs and pushing it towards more productive assets? Is it just that, or is it something more than that? That's all I really wanted to understand. Thank you.
No, thank you, Yogesh. So in that piece, I was just trying to identify some themes, because there's been so much discussion in the nitty-gritty of the budget that the idea was just to say, what are some of the intellectual departures from this budget? One of it was the transparency and the conservativeness. The second was the public investment paid for by asset sales. But the third part, and this is the one you alluded to, was really on infrastructure financing. Because if you go back to the old model, there's a recognition here that we will need private monies to help build the infrastructure, because the state just doesn't have the resource envelope that's required to build the infrastructure required. But the risk sharing that was envisioned previously, a decade ago or so, was one in which, in a way, the private sector had to take on some of the upstream risk. In some cases, land acquisition or clearances or regulatory approvals. And we found out that the private sector was not their comparative advantage. That many of these projects got stuck, in the early part of last decade. infrastructure projects because the private sector could not handle some of that implementation risk or execution risk. And in fact, the NPAs we spoke about also emanated from some of these implementation bottlenecks. The departure that I'm referring to is implicit in the budget, I think, is a sense that now the public sector will build the infrastructure of its balance sheet. So it will, do the upstream, take land acquisition, get the clearances, and as an example, build the road, right? And because I think the public sector is better equipped to handle that, to mitigate that upstream risk. Now, in theory, once that road is economically viable and traffic is stabilized, and I'll give an example, it's a toll generating road, which sustains itself. There is nothing that should stop us from selling that road to the private sector, to say a pension fund around the world that wants to operate that road, right? So in a way, what we're doing is we're now bringing the private sector in, not at the beginning of the process, but at the end. Once the project is economically viable and functional, then you sell it to the private sector who operates it, and the resources that you get for it, you try and build the next road. Again, I don't want to overstate the case, but I think that's a different way of building infrastructure. And my simple point is, again, just want to understate the importance of execution. That again, asset recycling, I think conceptually is the correct way, but we need to execute. But that was the point I was trying to make, that the risk sharing between the private sector and the public sector in this model is different from the earlier model.
Yeah. May I request Mr. Arjunan MG to ask his question?
Hello?
Yeah.
Sir, whether it's audible?
Yeah.
Hi, sir.
Yes.
Sir, sir, I have a doubt. I'm not so much well in this field, but in our budget, our government has announced the disinvestment plan of 2 public sector units and the insurance company. I know this is a very critical and important thing for the investments for the private sector. But my doubt is that whether this will be more helpful for the poorer people, which means in Mahatma Gandhi Rural Employment Scheme, many poorers are now, many daily wages are increasing. The count is increasing day by day, which clearly shows that the demand is getting decreased due to this pre-pandemic and post-pandemic. So I think we want to concentrate on public investment quite more than the disinvestment of the public sector assets. So can you give any suggestions regarding this?
No, thank you. So you're right that the demand for NREGA is high, which suggests that the labor market remains soft. And so there are 2 things we need to do. One is make sure that NREGA is fully funded. And so anybody that wants an NREGA job can have it, because think of that as our unemployment insurance in the rural economy. It's a demand-driven program. So there's a self-selection there, and that's important that we completely fulfill the demand. But you're right, this is all about demand now. That's the point I've been trying to make for a long time, that, this is a different kind of emerging market crisis. Normally, an emerging market crisis is one where you've got overheating of emerging markets. It results in higher inflation, results in higher current account deficits. You become very stretched. You have imbalances that develop, and then there's a global shock and you have to tighten your belt. This is a completely different kind of crisis. I was telling you in the beginning that the IMF estimates there'll be 110 countries whose per capita income in 2022 will be lower than 2019. So this is really about boosting demand. There's a lot of slack in the economy. The labor market numbers that you refer to is a reflection of that slack. So really, the goal is how do you boost demand? And my point is the government will have to play an important role in keeping demand elevated. Therefore, the big focus on public investment. I think the disinvestment is a way to pay for some of that public investment. If you don't pay for it and your fiscal deficits become too large, then you've got debt sustainability problems, and then your financing becomes so unviable that you will see interest rates in the bond market going up, and that itself can choke the recovery. So the balancing act here for the government is how do you boost aggregate demand through higher public investment and yet gradually bring your fiscal deficit down so that you don't cause too much of a tightening in the bond market in terms of interest rates and financial conditions. And the only way to square that circle is to finance some of your new public investment by selling assets. There's no other way really to try and achieve both objectives.
One last question. May I ask Mr. Vishnu Prakash to ask his question?
It's not there right now.
It's not there. Okay, great. Thank you so much, Sajjid, for joining us. And thank you, everybody who could manage to join Sajjid in this conversation. And thank you, associate partner of Indian Express in this Explain Live program, Vision IAS also. Thank you.
Thank you very much, Reddy, and thank you for the great questions, everybody.
Thank you.
Stay safe wherever you are.